So Constellation Software is going to be the first stock in a series that I want to make on stocks that I believe can grow at greater than 10% compound annual growth rate. For myself and most people investing, if you can accumulate stocks that you think or do grow greater than 10% per year, you keep adding to them, you should have more than enough wealth at the end of your life. So that's the bar I'm setting when I evaluate things, and Constellation Software is something that always met this bar, watched it for a long time, and then finally decided to invest in 2020. So I want to go through why I first liked the stock, and then the numbers that I've gone through, the financials that reiterate my love of this stock. So if you go back as far as you can to 2017, it's compounded at almost 36%, which almost sounds too good to be true. I really can't find anything that's performed as well as Constellation Software over this time. I'm sure there might be something on the NASDAQ that has done better than this. Now, to get these graphics, I've been using, I really love Canada Stock Channel's compound return. It's just so easy to throw in tickers, compare stocks, and see how they do with or without compounding their dividends. So there's well over a decade, 15 or so years of track record. So pretty impressive what they've done. If I zoomed in a little bit and look over the last 5 years, this includes the pandemic, they're still doing pretty well. Not quite as well, but way better than that 10% that I kind of use as a bar to decide what stocks I might consider. Last, particularly for the sake of this video, I want to look at, during the pandemic, how is it doing? This is a tech-related stock. They're in vertical market software companies, dozens and dozens, hundreds of them. Okay? So it has a bit of a tech focus to it. So you think it might have crashed in the last while. And it's not what you see. The pandemic hit in March 2020, which is the start of this chart. It dropped not quite 20%, and then strongly recovered. Okay. Now it has sort of peaked where most of the tech stocks did peak, somewhere between this winter and just before Christmas, but the drop isn't cataclysmic. It's not a very volatile stock. If you look over the COVID period, it's still compounding 16% if you do include dividends. Now it's only $1 per share, so including the compounded dividends doesn't make much of a difference. So the chart is certainly nice. Not that this is enough, but this is certainly what intrigued me into the stock. What pushed me a little bit more to make this video was how not volatile it was over the past couple weeks. September 13th is when the US CPI came out, and the month-over-month CPI was up 0.6%, so much higher than people were expecting. That's the core number. And yes, it dropped, but over the 5-day chart that I pulled up, it only dropped less than 2%. So for a company that's invested in software, that's in technology, that's not much of a drop. So it's one of those companies I don't even really look at. I buy, I add to, it's never going to be up 5% in a day, and conversely, it's never going to drop a huge amount in a day. So what do they do? This is how they describe their business. It's from their annual information form. They sort of use the same language over and over again, that they're in vertical market software, and they really try to stay to small and mid-sized companies. They're not invested in large ones, and they don't believe they can continue their high rate of return if they invest in large companies. Now they're in so many companies, I'm not even going to pull them up. They have 5 divisions of software companies. They're not really exciting to talk about any of the individual ones, but they're an incredibly diversified company, and they just keep slowly taking their cash flow and adding to their businesses. They generate more cash flow and they reinvest it. So more of the math of why you might be interested in this company. The nicest chart I got was from their president's letter in 2018, where they lay out their annual adjusted net income, and how well they can do on return on invested capital. And they're constantly getting a great turn. These are great managers of money. They take free cash flow, they invest it back in new businesses, and just rinse and repeat. Their organic growth isn't that high. They talk about wanting to improve companies, but that's not really why you're invested in this company. They're just great at allocating capital, being very patient, not getting impatient and buying something that's too big, that doesn't really fit their plan, but just because there's nothing available. So return on invested capital plus or organic growth is incredibly high. And again, it's such a track record that they have year over year. So what Mark Leonard uses as his most important measurement is free cash flow available to shareholders. So that's what I focused in on their numbers and wanted to continue to look at from their charts they posted in 2018 and continue those charts on my own. They talked about, they do pay a dividend and occasionally a special dividend, but they're not going to do any special dividends. They're not going to repurchase shares. They're able to take this cash flow available to shareholders, and the best thing they could do is invest it. I keep wondering why they bother with this $1 dividend. They don't dilute their shares. They don't issue shares. So this is a bit of a wild guess, but I assume it's just as a form of salary. Why would you want to take salary, take dividends, get the dividend tax credit? So that's a guess of why they do the dollar, but I'm really not sure. So this is their cash flow from operations. This is what they believe is the most important metric, or certainly their CEO, and it's just a constant increase and an amazing compound rate, well above that 10 or 20%. So they're very disciplined. They don't have bad years. They don't seem to have big damaging deals that wreck this cash flow and stop their great compound annual growth rate. Now, their president's letter only had this up to 2017, and I couldn't find this chart continued anywhere. So I had to dig through a fair bit of annual statements and continue this chart. So I was able to confirm that I was using all the right numbers in my cash flow, because I could go back to their cash flows and confirm. So their 2015 was 1868. And that matches up with what I pulled from their financial statement. Mattered, they don't call it free cash flow, they use slightly different wording. So once I'd confirmed that yes, I was pulling the same numbers, I built this chart using their annual numbers all the way up to last year, and the trend just continues. Even right through the pandemic, the free cash flow available to shareholders is just constantly increasing. So this is why I don't really care what the share price is. If they keep compounding at the rates they do, the shares will keep going up. It's not a concern. I'm not looking to sell it. You don't really get great dips to buy this stock, other than when a global pandemic hit and they dropped 15-16%. There hasn't been a great chance to buy the shares on the cheap. They did have a drop in net income, not that it's a big line to look at, but they talked about some non-cash items that drove that down. One thing I was amazed, I've never seen this, please put in the comments if you've ever seen this, but like the share count, every year I looked it up, it was exactly the same. When I first started investing, I kind of figured, that you invest in a company, they issue shares, the share count would stay the same. And then as we all learn, the dilution is brutal in most companies, but it's not what Constellation does. They're not buying with shares. They're taking free cash flow, investing it really well, and growing the future cash flow, which just means they have more cash flow to buy more companies. Now, they do stay in the small and mid-sized space, rarely making larger acquisitions. But particularly during the pandemic, I was curious whether this had sort of cratered or faltered, but it hasn't. They're not in exciting companies. They're recurring contracts. It's just steady cash flow type software companies that they're invested in. I did use all the annual numbers. when you go through, they talk about a bit of seasonality. So it's not really worth looking quarter by quarter like I have in their MD&A from their most recent statements. But there's a nice comment in here under their quarterly summary that they experience seasonality in cash from operations and free cash flow available to shareholders. Every first quarter is the highest, and then it drops a bit in the second quarter. So you got to watch if you do start looking quarter over quarter and you see a drop. I've just found it best to analyze this company by looking at their annuals and the trends. Again, there's so many companies, it's hard to analyze exactly how they're doing on a quarter by quarter basis. You can't sort of study one of their companies and make predictions from that. This is where I got the free cash flow. So the wording that they used was the net cash flows from operations. So that is their free cash flow available to shareholders. And again, I was able to back test that I had the right numbers by comparing the numbers in my Google Sheets to what they had in their report, and it matched up. So I definitely had the right numbers. I was worried I was going to have to calculate my own free cash flow by subtracting all the non-cash items, but I didn't have to. It was in their financials for me. So I first invested in this company in May 2020. I watched it, never got a dip, never bought it. This pandemic came along that gave a lot of buying opportunities for a lot of stocks. So I did my first buy in May, and then shortly after in July. I'm just slowly trying to add a few shares per year. Right now, in total, I have 24 shares. It's about 64,000. It ranks fourth currently in my portfolio. It was a bit lower, but things have gotten hit, so it's worked its way up. Tesla is number one. I've been certainly lucky with this. I got into Tesla in 2019 or so, and that was a very convenient time. Lots of people invested it previously, and you sort of didn't go anywhere in 2016, 17, 18. I do have options on this. I have 3 call options for 2024. I think it's January. I keep buying these 6-month or more recently, as long as I can, call options. So if Tesla drops a lot, 20, 30%, I've been picking up one of these calls. Tesla's very volatile. You can almost count on 30% drops every year or two. So I haven't been picking up shares. Now, more recently, when it dipped in the 600s, I started buying 3, 4, 5 shares. I think I have 510 shares of Tesla. Whitecap I like for the dividend. Brookfield again for the dividend. Another great compound grower. And then I've liked Lightspeed for a while. Unfortunately, in the pandemic, I've kind of gone through this U. I definitely bought a bunch. Watched it for a long time. Wouldn't buy it in the 40s or 50s, fell to the 30s, I bought some. In the pandemic, I bought a bunch, rode it up, only unfortunately sold about 10%, I think, of my shares. I think I ended up with 600 or 700 and sold 100. It's come back down, and I've probably doubled up again. I own Shopify too, but right now, I like the Shopify trades. It's just such a larger annual recurring revenue compared to Lightspeed. So that's my portfolio, or at least the top 5. Why I like Constellation, and suggest it's something that you may want to consider investing. Can't predict the future, but certainly like the past.